dip buyers on the European energy markets might be getting more than they are bargaining for, with TTF, NBP, German Power, and EUAs all expected to move lower this week. But what are the trigger levels and how far can it go? All that and more in today's energy market pulse on the 2nd of February 2026. My name is Marcello Colax. I'm the managing director at Clever Markets, and I'll be walking you through the charts. First things first, nothing you see here constitutes trading advice. It is just my humble opinion, is not an invitation, and does not count as trading advice. All right, so this is the TTF sentiment benchmark that we have for you this Monday morning. So you can see from week to week, we did see a marginal shift where 2 weeks ago the bears were slightly in charge with 43% versus the bulls with 36, and now it is the bulls that are in charge with 47 versus the bears with 39. This is a marginal shift, and overall, I feel that the market is still reasonably balanced. So this is a normal market state. This is nothing absurd. This is when normal trading happens. Until we start seeing some extreme sentiment shift towards one bias, it is all looking all right to me. This is the front page of our dashboard this morning, and you can see that most gas and power markets are still neutral on the hourly chart, but we are getting ready for a steep decline. So here, once again, what we are showing you here is the current state of the market on Monday morning. This is not a prediction. Way more important, way more tradable than any sort of price forecast you could ever get, because here this state is telling you what market strategy is recommended. So in a sideways trend, we are looking for mean reversion strategies. What does that mean? We start moving into the lower level time frames. We start working with oscillators and look for reversal candle patterns in the peaks and the troughs of those range markets. Once we break past that, we are switching towards a trend following strategy where we start looking at trend and momentum tools. We start drawing in trend lines and maybe put the stops a little bit further away. Isn't that amazing? With our little front page here, we are already helping you select the right trading strategy. A lot of our clients at Clever Markets combine their existing fundamental models with our technical approach. If you want to get started as well, then I highly recommend that you join our free masterclass where we teach you how to combine your existing fundamentals with modern technical analysis. This is the last time I am probably advertising this. If you scan the QR code, you can apply to participate. We scan everyone individually, so it might take some time for us to get back to you. We have to reject around 30% of applicants, so make sure that you are a professional European energy trader. Whether you're on the spec side or the physical side, you will get something out of this. Now let's have a look at the TTF front month daily chart first. So you can see here that last week we have been moving sideways within the 37.14 and 43.38 sideways range. Trading opportunities were extremely limited and mostly restricted to the hourly chart for a little bit of short term in and out. Momentum traders really just had to sit on their hands right now. Anyone who is already long might be deciding to fade near this area in the 43.38 right now, because we don't expect the market to move significantly higher. In fact, we do believe that a move below the 37.14 is most likely. Now, why is this? First of all, that's what our proprietary algorithms are saying. They're showing us that the market has reached a transition phase away from this bullish stance. Having a look at this, we also see that the stochastic is moving marginally lower. So here we are already seeing a flow of lower lows and lower highs, while the MACD is topping out. So this also increases chances for the market to eventually push lower. Now here's the thing. We might be seeing some dip bias, especially on the hourly chart. We'll talk about that in a second, near 37.14, right? Because they hope that the market will continue to swing sideways. We, however, believe that the market could easily break below that level. And if we do, then a lot of dip buyers near 37.14 will be very, very wrong. So if they scramble to close their long positions, this could initially fuel the down leg towards 33.29, which is both the 61.8% FIB retracement of this up leg here, with the 0 up here and the 100 down there, and it also coincides with the 200-day exponential moving average. If we find support here, probably this might be the more attractive dip buying opportunity for many. And this is what's happening on the TTF front month hourly chart. Can you see after this prolonged uptrend, we have a head and shoulders pattern tentatively forming, probably with a more complex right shoulder, but ultimately a move below the around like 36.8, below the neckline. It's a thicker line, but around this area, there below this, the bears would be fully in charge. We would be getting a bearish head and shoulders target. We could easily make it towards the 33 area. So that's what I meant with the daily chart, right? So the buying has worked here once, twice, a third time, but now a fourth time they might not be so lucky. And if they are, and the market continues just a little bit sideways, the bulls are still not fully in charge until we hit the 40.65 key resistance and move past that. Even then, you can see we don't expect massive gains anymore. So now is not the time to chase the bull trend. The same applies for the TTF front season as well as the NBP front month and front season as well. They're structured in a very similar way. Now it's time for the German power front year. So here on the daily chart, we see that we have been pushing into this increasingly tighter ascending triangle. We have now hovered near the 87.7 for quite some time, and trading opportunities are nearly non-existent on this time frame. Because look at that, right? We get like large gaps. We do get a big red candle followed by a green, by a red, by a green, long wicks, small bodies. So there is no good trading opportunities here. Overall, we do believe that the market is roughly sideways within 83.96, so let's call this 84, and 87.7. We do think, with information available to us right now, that the move lower seems more likely. Our quant signals are showing us that this little bull move here is exhausted, not really trending anymore. We see that the MACD on the daily chart has topped out. Stochastic has been pushing lower. There's currently no dominant force in the market according to the DMI or the ADX rather, but a slight bearish bias seems to be forming. And that's completely normal. I mean, we are still within the ascending triangle, so another move lower, maybe towards this trough, the 81.95, maybe somewhere in the 81 area, this could be possible. Zooming out, overall, ascending triangles are usually eventually resolved to the upside. I'm not seeing that right now, but if we were to push above the 87.7 after this down leg, then the bulls would be fully in charge. But for now, we're just dealing with an increasingly tighter range, which remains nearly untradeable for trend followers on the daily chart. And this is the reason for the untradability. On the hourly chart, we started out with a rectangle. Looks super neat because here in a sideways trend, we are looking to deploy mean reversion strategies. We're trying to buy at the lower end, trying to sell at the upper end, both with oscillator signals as well as candle reversal patterns. This worked out well for like a couple of swings, but you can see here we are no longer hitting the upper end of this rectangle. We are instead drawing in this tentative descending triangle. So this is telling me two things. First of all, descending triangles in general are usually resolved to the lower end. That's because the market is willing to buy at lower and lower and lower prices, whereas the support remains the same. So from a psychological perspective, eventual downside seems more likely. Also, we started out with a rectangle, and if one side of the rectangle is no longer hit, there's usually also showing exhaustion, which makes a move lower more likely. So if we make it below the 84.4, somewhere in this, you can see it's like a broad area. It's not a fine line. It's a broad support area. Then the bears will probably decline towards the 82 area, exactly as it is the case on the daily chart. So with this setup, the bears seem to be coming out on top. Now, here's the thing. In case this is wrong and we start pushing above this descending triangle resistance near 85.5, maybe even this peak here at 86.59, the bulls still wouldn't be in charge. We would only be seeing a re-establishing of the rectangle range. If we're talking like full-on bullish conviction, once again, it's above the 88.4. So even if we move higher, the bulls are still not in charge. During such difficult phases, do not use trend tools, do not use momentum tools. They will only give you false signals. If at all, right now this year, this range is untradeable. Wait for a break past either direction. Now let's have a look at a market that most of you are probably super interested in, EUAs. Here on the daily chart, we have now established a flow of lower lows and lower highs. It started to look a little bit tricky here. You might remember we had this uptrend within the channel. We did break lower with these two red candles. At Clever Markets, we have already established that the market is exhausted with this green candle. So we are bang on. We, however, said that the bears after these two red candles are still not in charge because our algos were still indicating a non-trending regime. And this might have prevented some traders from having a too big of an opinion too soon because we still had then 1, 2, 3, 4, 5 days of indecision. And some traders might not have been willing to wait this out had they already formed a position either, I don't know, to the upside or to the downside. Now that we have completely formed a flow of lower lows and lower highs, it does seem more likely for the bears to continue towards at least the 77.74 if we make it below the 80.54 this morning. And we see that here, the volume is up on the red candles. The momentum tool, the MACD, is pushing below the zero line. That's super bearish. We are not getting any bullish signal on the stochastic, and we are seeing that the DMI is also moving bearish. And this downtrend is best traded on the intraday chart because, as you know, EUAs, they seem to be moving very quickly, and within just 1 or 2 red daily candles, it's all over. So if you want to make use of this down leg, rather have a look at the hourly chart where we are dealing with swings again, so it makes it a lot more tradable. So a move below 80.73 seems likely this Monday morning towards here. Once again, the 79.04 is like the immediate target we are looking at before we start looking for a bounce. If we approach this area, start looking for bullish reversal candles and also a bullish oscillator signal. If you don't get that, then we might be simply continuing lower. And here's just a little tip. As we are approaching all these support levels, always look for, is the bearish volume still there? Are we getting a bullish reversal candle? What is the oscillator saying? Is the momentum still bearish? So these are all the things you want to consider. Now here's the thing. If we bounce, this is more likely to be a corrective move in an underlying downtrend. So even if we bounce at any point here, we still expect the market to move lower thereafter. So the peaks that result from the bounce might be good short selling opportunities. Why do we think that? We think that because the trend tools and the momentum tools are still firmly bearish, which means that any up move signaled by a bullish candle and a bullish oscillator signal is more likely to be just a correction in an underlying downtrend. Now, here's the thing. When do we know that the bear trend is over? As soon as we start seeing that the bearish momentum is like flattening out or maybe even rising while the price is still moving lower, that's called divergence, then a small bullish signals from the oscillator and the bullish candle would probably most likely be the start of a full-on trend reversal. For now, I don't see that happening, but please do monitor the markets for exactly that. And that's all for today. I hope you found some value in that. I'm looking forward to welcoming you at the free Clever Markets Masterclass on combining technicals with fundamentals. Everyone, have a good start into the week. See you around and bye bye.